Hi, thanks for visiting my channel. For anyone new to this channel, my name is Chanveer Chaudhary. I'm a certified financial planner and a real estate investor. I make educational videos regarding wealth building, financial planning, and real estate investing. I make one fresh video every week. You can visit my channel and find videos about different financial planning and real estate investing topics. Before we get started, if you think you learned at least one new thing from this channel, all I ask is to subscribe to this channel so more financially savvy people like you can benefit from this information. Topic of today's video is how to reduce capital gain tax on rental real estate in Canada. Today we are not talking about principal residence, since one principal residence is tax-free in Canada due to principal residence exemption in the Income Tax Act. Principal residence stays tax-free within your lifetime and passes on to your beneficiaries tax-free upon your death. Also, if you own qualified family farm or fishing property or qualified small business corporation, capital gains are tax-free due to lifetime capital gain exemption of approximately $1 million in year 2023. Before we start talking about how to reduce capital gain tax, let's first define how capital gains and losses are calculated. In Canada, capital gains or losses have to be reported either when you sell the rental property or change the use of the rental property by moving into it and converting into principal residence. You also deemed to have sold the rental property at the fair market value if you gift the property to a family member, you became non-resident of Canada, or when you passed away. This is called deemed disposition. Gains on the rental property are considered capital gain if property was considered buy and hold. Only 50% of the capital gains are currently taxed in Canada, either when you sell the property or deemed disposition. This is called capital gain inclusion rate. If rental property is purchased with the intention to flip or assignment sale within a year, gains on that rental property will be considered business income and will be 100% taxable, same as RRSP withdrawals. Let me give you an example. If you purchase the rental property for $100,000 as buy and hold and sold the property for $200,000 after a few years, even though you made $100,000 profit, you only have to report $50,000 as capital gains. This $50,000 capital gain will be added to your taxable income for that year. If you already made $100,000 from your day job that year, extra $50,000 of capital gain will be added on top of it and will be taxed at your marginal tax rate. Canadian personal tax system is a progressive tax system, therefore has tax brackets. More money you make, more taxes you pay. In Ontario in year 2023, if you have a taxable income of over $236,000 from all income sources, you are in the higher tax bracket and have a marginal tax rate of 53.5%. But since capital gains are only 50% taxable, the maximum capital gain you'll ever pay is 26.76% in year 2023. Since you only need to add 50% of your capital gain to your taxable income for that year. Now let's talk about how to reduce the capital gain tax on the sale of rental property in Canada. First way to reduce the capital gain tax on the sale of rental property is by increasing the adjusted cost base or ACB of the property and reducing the net sales proceeds. You can increase the adjusted cost base of the property by adding the acquisition cost to the purchase price of the property. For example, legal fees, title insurance, land transfer taxes, inspection fees, appraisal cost, or any capital improvements you might have made over the years to increase the life of the property. For example, new windows, new roof, etc. Current expenses cannot be added to the cost of the property. For example, fixing the leaky faucet, shampooing the carpet. These kind of expenses are deductible against your yearly rental income. You can decrease the net sale proceed when you sell the rental property by deducting the legal fees, real estate commission including HST, any mortgage penalties you might have paid to break the mortgage. Second way to reduce the capital gain tax on the sale of the rental property is to sell it in your low income earning years due to job loss or medical emergency. Also consider selling rental property after January 1st rather than later in the calendar year. This will give you more time to plan in order to deal with the capital gain tax and defer the taxes until the following calendar year. Dollar deferred in taxes is better than dollar paid in taxes today due to time value of money. Third way to reduce capital gain tax on the sale of rental property is to sell it before age 65. People usually have one or two income sources during their normal working years, but they have multiple income sources in their retirement year after age 65. For example, old age security, CPP, guaranteed income supplement, pension plan, RRSP, or RIF payments. If you sell rental property in your retirement year after age 65, any gains will be taxed on top of the other sources of retirement income. Since some of the government benefits are income tested, for example, old age security and guaranteed income supplement, if you have high income in 1 year due to sale of rental properties, these government benefits could be completely clawed back and you could lose tens of thousands of dollars in government benefits. Fourth way to reduce capital gain tax on the sale of rental property is to purchase with the immediate family member like spouse or adult children. If you have a spouse or adult children on the title of the rental property and they are in the low tax bracket, not only you can split the yearly rental income, but you can reduce the overall family tax bill. You can also split the capital gain on the sale of the rental property and reduce the capital gain tax. Fifth way to reduce capital gain by gifting rental property to your adult children early in your life. If you had planned all along to pass on the rental property to your children upon your death, consider gifting it early in your life in the years when the real estate prices are low. Since there is no gift tax in Canada, but there is a capital gain tax when you transfer rental property to your adult children, by gifting the property when the real estate prices are low, you're transferring the tax liability to the future generation and lowering the capital gain tax for you. Sixth way to reduce capital gain tax on the sale of rental property by making RRSP contribution by catching up on any available contribution room you carried forward from previous years. Since any RRSP contribution reduces your taxable income for the year, it's a great idea to keep any available contribution room if you're planning on selling the rental property in the near future, and make RRSP contribution in the year of sale of the property. Seventh way to reduce capital gain tax on the sale of rental property by not claiming capital cost allowance against the rental property. Building portion of the rental property excluding the land can be depreciated to the maximum of 4% per year because building wears out and become obsolete over time. This is called capital cost allowance or CCA. If you claim CCA over the years against your rental income, CCA gets recaptured and gets added to the income in the year of the sale of the rental property and increases the capital gain tax. Eighth way to reduce capital gain tax on the sale of rental property by offsetting against capital losses you might have from other investments. This is called tax loss harvesting. Since capital losses carry forward indefinitely, you can use capital losses from prior year to offset the capital gain on the sale of the rental property. Capital losses can be used to reduce or eliminate capital gain but cannot be used to reduce any other income. Ninth way to reduce the capital gain tax on the sale of rental property by spreading out the capital gains over the next few years. This is called capital gain reserve. One of the great way to do that by offering vendor take back or seller financing to the buyer of your rental property. With seller financing, you're allowed to take a reserve and defer the portion of capital gains on the sale of rental property over the maximum of 5 years. If you have rental property which is mortgage free and you don't need the sale proceeds right away, consider offering seller financing to the buyer of your rental property to earn a high monthly income and spread the capital gains over the maximum of 5 years. This will help you get the sale price you want while helping the buyer qualify for mortgage. This is win-win for both buyer and the seller. 10th way to reduce capital gain tax by donating the rental property to the Canadian registered charity of your choice. If you donate the appreciated rental property to the charity, you'll get the donation tax receipt for the fair market value of the rental property in the year of donation. 50% of the capital gain will still be taxable in the year of donation, but donation tax credit will exceed the capital gain tax owing, resulting in net tax savings. Please note the donation of rental real estate is not exempt from capital gain tax, while donation of securities are exempt from capital gain tax while receiving the donation tax credit. That's all for this video. If you think information like this can benefit someone, please share this video. Also like, comment below, and consider subscribing. Thanks for watching and see you in the next video.